Welcome to The Explainer. Today, we're diving headfirst into the high-stakes world of oil and gas. And believe it or not, we're going to see how a single accounting choice can make a $10 million loss, well, just disappear and totally rewrite a company's story. All right, so let's just jump right in with a question that really gets to the core of this whole thing. Imagine a company sinks millions of dollars into drilling a well, and they come up completely empty. Is that a massive, devastating loss for the quarter, or is it, just part of the game, another cost of doing business?
Well, how a company answers that question really depends entirely on which of two fundamentally different accounting philosophies it follows. And trust me, this isn't just some boring technical detail, it's a huge strategic choice with massive consequences.
So, on one hand, you've got what's called the successful efforts method, or SEM. Think of it as being super conservative. You only count your wins. Only the wells that actually strike oil get to be called an asset. Everything else, bam, it's an immediate expense. But on the other hand, you have the full cost method, or FCM. This approach is totally different. It's like saying, hey, it's all part of the journey. It lumps everything together, the big gushers and the big dry holes, and calls the whole shebang an investment. Okay, let's make this real. We're going to see how this plays out with a pretty simple case study. We'll follow two companies that make the exact same bet, but end up telling two wildly different stories to their investors. So here's our showdown. We've got two companies, Titan Oil, a huge, major player, and Indie Drillers, a much smaller explorer. They both spend exactly $10 million on a new well. Titan, they strike gold, a real gusher. Indie Drillers, they come up completely empty, a bust. Same bet, but two very, very different outcomes. And now, the CFO at each company faces a critical decision. How in the world do they account for this? Their choice is going to dramatically alter their company's financial story and completely shape how investors see them. So let's start with a big player, Titan Oil. They use the successful efforts method. It's a very conservative, by-the-book approach, and it's actually the one preferred by the Financial Accounting Standards Board, the FASB. The philosophy here is really simple. A dry hole isn't going to make you any money in the future, so it can't possibly be an asset. That cost has to be recognized as a loss, right now. It's a direct hit to the bottom line, this quarter. So for any company using this method, a $10 million dry hole means a $10 million reduction in profit for the quarter. It's a direct, it's immediate, and it's a painful hit right on the income statement. But now let's switch gears and look at Indie Drillers. As a smaller company, they use the full cost method. This approach, which the SEC actually allows, looks at exploration in a completely different way. Their logic is that dry holes aren't really failures in the traditional sense. They're just a necessary, unavoidable part of the process of finding the successful wells. So because of that, all those costs should be bundled together and treated as a single large investment. So instead of taking a $10 million hit to their profits, Indie Drillers gets to shelter that cost. It just goes right onto their balance sheet as an asset, and it gets slowly depleted over the life of all their other wells in that entire region. And here it is, the result. Side by side, look at that. It's a total night and day difference. For the exact same event, a $10 million dry hole, Titan Oil has to report a massive expense. Indie Drillers, using the full cost method, reports zero impact on its profit for the quarter. It's pretty wild. So this probably seems like a no-brainer, right? Why would any company choose to take that $10 million hit if they don't have to? Well, it all comes down to your company's size, its strategy, and really the story you want to tell. You see, the large established companies like an ExxonMobil, they use successful efforts to prove just how efficient they are, to show off the success of their individual projects. But the smaller explorers, they use full cost to survive the crazy volatility of this business and to avoid having a single dry hole completely wipe out their earnings for a whole quarter. What's really fascinating is that even the top financial regulators in the US are split on this. The FASB, the official accounting rule makers, they really prefer the super transparent approach of successful efforts. But the SEC, which governs the public markets, they allow the full cost method. They recognize that it helps smaller companies compete and encourages that risky but necessary exploration. So, what is the bottom line in this accounting showdown? It's that the numbers you see on a financial statement don't just reflect reality. In a lot of ways, they create it.
The most crucial point to take away is that accounting isn't just some passive recording of things that happened. It's an active tool. It's used to shape a company's story. It affects the profits they report, the value of their assets, and ultimately how investors and the entire market judge their success.
And that leaves us with a pretty provocative question, doesn't it? This whole choice shows just how much financial reality can be shaped by perspective. So if a set of rules can turn a $10 million loss into an asset on paper, you have to wonder, what other hard facts in the business world are actually just stories we choose to tell?